Hello, hello, hello. This is Truth Be Told, Dr. Kyle Dumpert.
And this is Dr. Walter Aka, and we have the pleasure of having I'm actually very excited about this. This is Dr. Justin Kress. He is a dentist in what state again?
Idaho.
Idaho, living the best life possible. And, he contacted us because we had mentioned, one time, I think maybe once or twice about syndications. And, we're like, hey, just bring somebody on that knows something about syndication. And sure enough, we got an expert.
Yep.
We're very surprised because we didn't even think people listened to us. So, Justin, we really appreciate you answering the call, man.
Oh, well, I don't. That's a lot of pressure for me. I don't know about expert and.
Justin, you lie until you make it, man. You fake it till you make it. All right, you are an expert compared to the other two people on this podcast.
That's right.
Right now.
That's right.
But honestly, Justin, I want to dive right in. I'm really excited about this, and I want to dive right in. But just give us a little history about yourself, your practice, and then just dive into basically what got you into syndication. What is syndication, and we'll go from there. We'll ask a lot of questions. Hopefully, we don't bore you to death, but we're going to ask these questions so that we can learn as well as our listeners learn as well. So let's start with basically your past. What happened? How did you get into dentistry?
All right. So I grew up in southern Idaho where I currently practice. My last basketball game in high school, I took an elbow to the nose and lost a part of my front two teeth and spent some quality time with my family dentist.
Okay.
I really liked hanging out with him after we got my teeth fixed. And then I talked to him about going to dental school. He really encouraged me. Then I married into a family where my father-in-law, my wife's uncle, and my wife's brother were all dentists as well. So,
oh, geez, no pressure.
Not too much. Went to dental school at Creighton. Nice. Graduated. Set up a practice in Wendover, Utah. Wendover's not the end of the world, but you can see it from right there. So my wife then informed me that she was going to move back home, and I was welcome to come with her. And so sold that practice.
That sounds
actually practiced with my brother-in-law a little bit, and then ended up spending 15 years with my family dentist that fixed my front teeth. Then we... a couple years ago, I moved back into the practice with my brother-in-law. So, so that's kind of got me to where I am today.
Okay.
Great. And so I'm guessing with all that, you were like, I need to do something besides dentistry, because that's the question that Kyle and I have been saying, I think, since the second day of practicing after dental school graduation. We were like, how can I do less dentistry? So how did you get into syndication? What is syndication? And let's kind of dive into that.
So a syndicated offering can be a lot of different things, but it's basically a business that you're allowed to buy in and be a part of. How I invest in syndications is as a limited partner. And I've invested in syndications that drill for oil and gas. Most of the ones that I'm in are multifamily housing syndications, and most of them with one operator. But there's just a lot of different things. So basically, it's just becoming part of a partnership, usually that someone sets up, and then you're able to buy into as a limited partner.
So how did you get into real estate then?
Yeah,
let's start with that. Like, how did you get into real estate?
So in 2015. I was getting pretty interested in real estate, and I was talking to my assistant as we're working on her uncle, and told her that I was interested in buying some houses to rent out in our local area. And he, once we got everything out of his mouth, he told me that he had a couple that he'd be willing to sell. So bought those, a couple of duplexes, and then bought a few more places, and started with something called Turnkey Investing through a company that invested, or that you could buy a house that was already rehabbed and that was already had a tenant in it, and they had places in both in Memphis, Tennessee, and then in Texas. So I purchased some places from them, mostly all in Texas, actually. So,
what was your experience with getting into rentals with not having any experience with that?
A little scary at first, but then my office manager was willing to manage all the rentals that I have in our local area. So that's great. I mean, so I actually now have in our local area, I have 2 duplexes, a triplex, and 2 single family homes, and then 2 buildings that are industrial that we rent out.
And how much of your free time outside of dentistry does that consume on a weekly or a monthly basis, owning those properties?
Almost zero.
Okay.
She runs everything with the residential type stuff. I do everything with the commercial stuff. Honestly, I drive by them to take a look, see what's going on. I live in a relatively small town, so I mean, on the way home, I just drive, a different way and look at different properties every time. But we probably rent the residential properties for a little bit under market value right now,
okay,
which means the tenants do not leave.
Right.
And so yearly we go and visit those properties just to make sure everything looks good. There's nothing crazy going on in there, but so far so good.
Wow.
So if that's the case, then why didn't you just kind of stick with that route, right? Because you have a few properties that you're doing yourself, and if it doesn't take that much effort, why go into syndication or anything?
Yeah, so that's an excellent question. One thing I will tell you is that I am an amateur at that. We rent them for under market value because we don't want to deal with the hassles, and because of that, I will say once in the last few years. I have refinanced all those properties, and so the money just trickles in now. So if you, if you want to get out of dentistry by renting out some properties that you own that you've got a mortgage on, think about doing profies instead of doing crowns. I mean, like we're talking, they just kind of trickles in a little bit. So, but it's that won't get you out of the dental chair, but it does build wealth. So I refinanced all of those, and then I put the money in some of these syndicated offerings. So I bought the property, it increased in value. I basically have all my money back out of all those properties that I've bought by doing refinance, and I put it all into syndicated deals because the money trickles in at a higher multiple, I guess you'd say.
Okay.
So with the syndications, I guess what was your entry point into this line of income or this line of an investment?
Okay, so you get interested, you kind of go down the path of they call these alternative investments instead of stocks, bonds, and mutual funds.
Right.
And so I joined a group that promotes a lot of syndications. Okay. So they provide education, and then he does a podcast too, listen to a lot of the things that he said. And then these offerings would come up, and they would do a webinar to explain what the offering was. And that just seemed like, number one, it was professional. Mm-hmm. And the returns were a lot higher than what I was getting in my single family or residential investments.
Okay. And
so then I guess the question I have would be, what was the return? I mean, if you're, there has to be a reason why you like it so much, right?
Right. So the one company that I deal with that does residential, basically multifamily residential rentals, their track record before I joined them was they were getting 30% return annualized. And you weren't getting it every year, but what kind of their plan was is that they would buy a property, they would be the general partner, they'd bring in a lot of limited partners. The return to the limited partners was generally around 30% annualized, and they held it anywhere from 3 to 5 years. So if they held it 3 years, rough math, you could expect about a 90% return. And this was not return of your money. This was return of, on top of your money coming back. And if they held it for 5 years, you could expect about 150% return at 5 years. So
okay, let's do the math real quick. So you're telling me after 3 years, let's just say you put 100,000 in, you're getting back 90?
190. So
190, 100 plus the 90.
Yes.
So why don't we all just stop with the market and do this?
So it's not easy. It's not as simple as getting an E-Trade account and, clicking on, clicking buy an Apple, but
right.
One of the hard parts, one of the hurdles is that you have to be what's called an accredited investor for most of these things. An accredited investor, it's kind of like the guy that I learned from. He said it's like kind of like being pregnant. You either are or you aren't. There's no application really. Or so if you're single and you have made $200,000 for a couple of years and intend to make $2,000 during the next couple of years, that's one of the hurdles that you can jump over. It goes up to $300,000 if you're married.
Okay.
Another way you can do it is if you have $1 million net worth that does not include your home. So the home that you live in. So if your practice is worth $1 million, basically you qualify as a accredited investor. So some of the places that I have dealt with, they just say, "Are you an accredited investor?" And I say yes, and off we go. There have been other there have been other places
Sure.
Where they have actually, they have a company that vets you, like they want to see your tax returns and all that kind of stuff. So, and then once, if you qualify as an accredited investor, then there's, you have to, in order for you to get into the deal, you have to kind of know the people. So they usually set up interviews and you get to meet them. And then they send you paperwork to fill out for each of the syndicated deals. That's relatively lengthy, so you have to read through it. One of the first ones that I invested in, I have a friend who's a lawyer. I handed it to him. It was a Delaware company that, and he just said, "This isn't in my wheelhouse." So, it wasn't something that any regular lawyer could look at and say like, "Oh yeah, that's easy. Yeah, just do that," Right. So there's a few hurdles you have to jump through. And so that's probably why a lot of people don't do it. I found that it's worth it to me. So,
is there a separate company or separate protections that you have set up whenever, the real estate for my practice is owned by an LLC. My business is an S corp. So, is there a separate holding that holds that syndication, or are you holding that personally?
So, protecting myself from the syndicated deal, I'm a limited partner. So my liability is limited to what I put into the syndication.
Okay. You
also have the other side though, where if I hold it personally, then I don't have protection from, say, if I got in an automobile accident. That's something that someone could go after there.
Gotcha.
So
gotcha.
So let's go back, Kyle. Can I go back to basically syndication? What are they actually doing that they can guarantee this return? Like, break that down and show me. Like, tell me basically from the beginning. They see like a multifamily, maybe 100 rooms or whatever. How does that whole thing work? What are they doing to basically guarantee this?
Okay, and Walter, since you and I talked the other day, I've thought about it a little bit, and so a lot of dentists will know about an Apple, stock or whatever. So I just wanted to simplify it by saying, do you think you'd make more money if you owned a piece of the company Apple if it didn't go through Wall Street and it didn't go through the CEO later, and those kind of things? So with that kind of general background, this is a business that runs just like any other business. And now going into specifics, but we kind of cut out the middleman, which is Wall Street, which is E-Trade taking their cut, which is Goldman Sachs taking their cut. Everybody's going to get their hands in the pie with this deal, there's usually like a promoter and then the business. So the CEO of the business, she often shows up at these apartments when they open them. She's there, and so it's there's just not a lot of layers. Not you don't have to peel the onion back a long way till you get to where the money comes in and out. So let's go to the syndicated apartments, as an example. So one of the things that I love about this this operator that I work with is that they have a plan from day one and they follow it to the T. The other thing, like I told you, they do a webinar to raise the capital. Usually these webinars get canceled now because they get subscribed fully before they announce it's going to come on in a week, and all the money is put in before the webinar even happens. But when I used to watch the webinars, when they had them, they were all the same. It was exactly the same. It was so boring. It's like, we're going to buy this place in Dallas, 350 doors. We're going to, raise this much money. We're going to make the units nicer, or we're going to raise the rent. We're going to bring in washers and dryers, and that all the things that they do, we're going to put up new signage. We're going to, take out all the old pool furniture. Everything they do is made to drive the bottom line, which is net operating income. How a syndication or how commercial real estate usually works is the price for an asset when it's bought or sold is usually net operating income divided by what they call the cap rate. The cap rate is set by the market, and so and a cap rate is a capitalization rate. It's if you put, let's say you didn't finance any money and you put 100% down and you just bought the asset. The cap rate is kind of like the return that you would expect, at the bottom line there. So you take this, you get this money. And so what the operator does is they drive net operating income up. That's what they can control. Bring in washers and dryers, rehab apartments, raise the rents, make sure all the rooms are full. And when they do that, they just increase the net operating income. When this operator buys an asset, two of them closed this last week and the last 2 weeks, they have people paving the parking lot, people taking out the pool furniture on day one. So they close in the morning. In the afternoon, stuff's happening. They show up with food trucks and really, try to bring up, the morale in some of these apartment complexes. Some of them have been neglected for years. I mean, they love showing pictures of signs that you can't even read, at the front of these places. And so the premise that they go after is most tenants don't mind paying more if they have a benefit, that they're seeing.
Right.
So, and so they raise those rents, and then they have usually a 3 to 5 year hold period. And then, generally they've been getting 30% returns, but a lot of it's backloaded. You don't get it till the end. Okay. So the other thing that really kind of, I guess last part before I let you guys chime back in, that really kind of got me is they said the worst performer that they had was, it did 11% annualized. That was the worst thing they'd ever had in about 30 properties that they'd gone through to do this.
No.
So on average, the S&P, I'm sorry, Kyle, on average, the S&P does about 8 to 10%, right?
Right.
And so if we're doing 8 to 10% by putting it in the S&P 500, you're beating that on the worst deal. The worst deal.
Okay. So where's the risk?
Like we need to get our. Go ahead.
There's risk. So any investment, anytime money either sits in your bank account, there's risk that inflation's going to eat it. If you put your money in an investment, there's risk that you're going to lose that money. On a scale of riskiness, with a savings account being next to no risk, up to some of the more risky things, where does crypto where does this fall?
So not all syndications are multifamily real estate. My 2 oil and gas syndications fell at extreme risk. I didn't get hardly anything back from those. Mm-hmm. The nice thing was they provided an extreme tax write-off, for me, not just because they were losers, but because that's just the nature of oil and gas. The oil and gas business is you get a big tax write-off for it. So you can tailor these investments to kind of do whatever you want. So the number one thing I will say, and this is the hard part, is you have to know, like, and trust the people that you deal with. Mm-hmm. Do I think a lot of these syndicated deals lose money at, different things across the nation? Yeah, absolutely. I think so. But when I was getting into these, I went to a meetup that they had at Phoenix, listened to them speak. We then hopped on 3 tour buses, and we went to 4 or 5 properties where they showed us, these are ones we're running. This one's been 1 year. This one's been, 2 weeks. This one's, whatever it had been. And the thing that was just crazy is that they all looked exactly the same. It was boring, So to me, I don't find that much risk in them. Like the worst one, 11%. The best ones have been over 30%. Obviously, if there's an 11%, there's got to be something to offset that, as well. So,
well, here's another thing too. Then, how did you find these syndicates? Like, did you just go to a website that says like findsyndicate.com? Like, how do you find these? Because if somebody's listening and says, "Man, this sounds great," and they want to start, how do you start?
So there are lots of podcasts, that you can listen to. That's probably the first place to start, looking on the internet, just finding different things. I will tell you, I think my family gets really kind of bored at what I do. I listen to a lot of podcasts. I think I have easily surpassed hours of education via podcasts on business and dentistry. Way more hours than I spent in dental school. Now, so.
Any recommendations for some names, podcast names to listen to?
Sure.
The guy who really got me going, his name's Buck Joffrey.
Okay.
He runs a podcast called Wealth Formula Podcast. That's the meetup that I went to. He's introduced me to a lot of those, different people. A lot of what I do today, I really owe to Buck. And I'll be honest, like I'm at the start of where these are starting to roll around.
Okay.
So
I look at this as it seems with all the stimulus money that went out, everybody's looking for something to invest in. And I think that's why the stock market kept going up and up and up, was there's all this extra money. Everybody wants to get these great returns. So if we are an accredited investor where, we have that $1 million of net worth, there's a lot more people out there that have a lot more net worth than we do. So I look at myself as a small fish in a big ocean. And why would somebody want my little bit of capital when they are, buying a 350 unit, multi-million dollar building? How much capital are you? What's the minimum? What's the maximum that you're putting in?
So the minimums on all the deals that I've done with the apartment syndication group is $25,000, which, that's more than lunch, but right. It's a lot less than it seemed like 3 years ago,
right.
So, and I've never put in the maximum. I don't know what that would be. They haven't told me what the maximum is, but
it gets chewed up there. You just buy the whole entire place.
It gets chewed up. I will tell you that I do know that they have done some apartment complexes where it didn't get syndicated to everybody that is in my group. Basically, some big family office took the whole thing down. So it does happen.
Oh, wow.
And you would kind of wonder, but going back to your question, why would they want your little slice of the money? Well, I think most of the time, the general partners or the people who are actually running the business, they don't have to put in any money if they don't want to. They can put in zero money. It's just their time.
Okay.
And so they're using your money, giving you a better return than I felt like I could get as than being a property owner, a small property owner, and their return is kind of infinite except for their time.
Right.
They're putting in a lot of time and expertise, and that's why I kind of started going toward the route of syndications, because they're professionals, at it. It's just plain and simple.
You answered my next question. I was going to ask if these are so profitable, why don't they just put their own money in and get their own 30% return? But it makes sense if why put your own money in to get that 30% return when you can borrow somebody else's, no money out of your pocket, and then have, like you said, infinite returns on that.
And the other thing is I wish I'd looked up how many they've done this year. It's been a lot. I mean, they've done, I would say, more than 10, probably between 10 and 20 of these deals this year. So that's a lot of money. I mean, it's millions and millions of dollars that they need to make these run. And so they would probably run out of their own capital if they were just using their own.
True. So. Here's one thing that I'm very if anybody knows me, I don't trust anybody. I'm very cynical about a lot of stuff, especially when it comes to my money. Right? We worked hard for it.
Right.
Most people don't think we work hard, but dentists, we actually do work hard. So the question I would have is, okay, so if you started maybe 12 years ago, 13 years ago, 14 years ago, I want to see how you went through 07, 08, 09. That's actually kind of like the barometer that would make me think you know what you're doing.
Right. So
do they allow you to see their history and then everything? I mean, is it very transparent? I guess it's a question I'm asking.
Yeah. So they on the webinars that they do, they have there's sometimes that they've put on all of their things that they've done. Mm-hmm. I'm not sure that they go back much further than like the 08, 09 time frame.
Right.
So, I mean, honestly, as you know, if you were able to invest through this whole time from 08 till now, everybody looks like a hero. It doesn't matter.
Exactly.
Yeah. It doesn't matter what you're doing. So I don't know what they might have done prior to that,
right.
But I do know what their plan is if the bottom were to fall out today.
Okay.
The thing that I like about multifamily housing is that it's not like retail that we've seen Amazon crush. It's not like office space that we saw COVID kind of kill. Everyone's going to need a place to live until we can figure out a way to box people up, some other way. We're going to be looking at these kind of apartments. And we don't buy the nicest, they don't buy the nicest apartments in Dallas or Atlanta or, wherever. They try to buy, somewhere just under. They also don't buy in the war zones. So they're trying to get into a place where if the economy's good, people are going to move up. If the economy's bad, people would be moving down. So they would be in a place where they would continue to rent. So they've been getting these, pretty good returns, but a lot of it's been on increasing the net operating income and then selling the asset in a few years. I know the plan is if all of a sudden, like there were no buyers, they would just continue to run the asset and we would have a stream of money coming in. It probably dropped to something like, I would guess in the 8 to 10% range, where they would just be giving you a percentage of your money, back each year.
And, and remember last year we had the whole moratorium on rents and evictions and so forth, right? So, I mean, that's another time, I guess, another timeline that's closer to this where you could have said, hey, what did you do through that? Again, I'm just throwing these questions out because for me, I'm a big question ask. I ask a lot of questions. Annoying or not, I need to know, So those are the kind of questions. Yeah, those are the kind of questions for me that I would personally ask. I mean, it sounds, it sounds incredible. It really does. That's the first thing I'm going to say. But I also want to know details so that so I feel comfortable, sleeping at night knowing, hey, my money is in good hands.
Right. So the first deal that I got into with this company is in Atlanta. Atlanta was hit hard by that eviction moratorium, and one of the properties that we have there was hit harder than the other. I've invested in two there. That one, the collection percentage dropped to about 84%. And just like if the collection percentage drops, it was usually more in the 95% range. As you know, in your dental office, if the collection percentage drops by 10%, where does that money come from? It comes from you. It's the last money out is going to be yours. That asset hasn't performed great. I have heard they've basically said that they think it's going to sell in January, and they're expecting. I will have been in that asset about 36 to 38 months, I believe.
Okay.
They think it's going to be, when they sell it, it's going to be a 14% return.
Oh, wow.
Annual return. So
right.
It was a dog. They fought and they just have it's kind of like one of those things where you just say, we've done enough. That's as good as we're going to get on this one. They didn't get down to the 11% return, so that's still the floor, for them. But so that's the situation there.
And are any of these, I think I heard you mention these deals for syndication, they're usually like a 3 or a 5 year. So these aren't long-term where you grab onto it and you hold it as an owner at that property for as long as you want to. Is that correct?
That's correct. And the ones that, there are some that try to market that way. Recently, almost no one has been able to do that because bigger money than accredited investors comes along and offers them a price they can't refuse almost, And so you've seen a lot of operators selling assets recently thinking like we got to be near the top, And so again, these accredited offerings or these syndicated offerings, you kind of have to look at how they're structured, because they also, not only do they provide great returns, but they, depending on how they're structured, they can pass on great tax benefits to you as well. So I'm a partner in the business. So when they take depreciation and things like that, that gets passed on to me and it goes onto my tax return. Okay. So if you keep rolling through these things, then you're, you don't have to just pay taxes on all this money either. You can keep kind of building wealth, which is what I chose by going with a higher, kind of average 30%, even though it wasn't just trickling in every month. I chose to go with this because I still have my dental practice. And so I don't need money coming in every month, so I went for the higher. If I hit retirement, then maybe I would say, okay, now I want to transition this into something that gives me monthly money or quarterly money. And then that would be, I'd maybe take a little less return to have, just more of a consistent thing. So each operator has their own specific way that they operate, and that affects the return and also the way that the tax benefits are handed down to the investors.
Okay.
And what about, so let's talk about 3 years has come up. You're done. You're like, okay, I'm getting my money. Do you just get that money in a big check and, you and your significant other goes and celebrates and has a good time with that money they just got? Or do you just then can reinvest it back into another syndication? How does that whole thing work out?
So
what's ideal?
Yeah. So if you're trying to grow wealth, I've heard people in my group refer to this as the golden hamster wheel. Okay. You get on, you run, the money comes back out, and then it goes right back in. And if you do that, the tax and kind of, it depends on how the deals are structured, but the taxes can be totally mitigated, and you just it's almost like an IRA. You keep growing this wealth tax-free because you get a gain, and then you put the money back in, and with what they call bonus depreciation and a cost segregation of the asset that you're buying, you get to depreciate a lot of that money right back out again. So to grow wealth, you stay on the hamster wheel. If I've tried to get it to where the checks don't show up at my house, it's just a transfer to my bank account. That way I don't have to take my wife out to dinner or anything. Don't have to split it.
But don't say stuff like that, bro. Kyle, find a way to delete that part. We are not trying to get anybody in trouble.
Believe me, we're over 30 minutes in. If my wife was listening to this, she'd be gone by now.
There you go. All right. You picked the right time to talk about it like that. So I guess to kind of put a bow on this, how do you think, somebody who is starting out, like a new dental student, right, just graduated, they have all this debt, right? Because we talk to people who have debt, all this debt, like they're nowhere near being an investor in something like this. But how do they work themselves up to that situation where they can, start doing something like this, because again, we all want to not work in dentistry for too long.
All right. So, I mean, if I were a new grad coming out of school with a bunch of debt, the number one thing that they can do is that they could buy a house. If I could talk my wife into it, that house for me would be a fourplex. And I would then, if you up to 4 units, you can get really great financing. We're talking probably 3% or lower for an interest rate, and sometimes 3% or lower down.
Wow.
And then so that's how I'd get into alternative investments of real estate. So easy. I mean, let's say that the fourplex costs, just for simple math, let's go back to $100,000. You can multiply it by whatever you want. Yeah. So if it's $100,000, 3% down, $3,000. So if you can come up with $3,000, let's call it 6 with closing costs and stuff like that you might need to come up with.
Right.
So $6,000, that's your investment, and then you would own, a place for you to live and 3 other places. After 1 year, most of those loan programs would let you move out and do it again. And so if you can do that 3-4 times while you're still broke, even, you have pretty soon you have 20 units, that are paying usually better than paying for themselves. And then, you could, if there's been appreciation, you could refinance, you could sell, and that's how you start to get, that'd be the number one easiest, simplest way to do it, that I can see. You just have to convince your significant other to live in a place with other people.
That's true. That's all good. And here's another thing too. Do they have syndications that are outside the U.S.? And can anybody from outside the U.S. invest in these syndications? Because we have listeners throughout the world. I mean, we still don't know how, but they hear us. So I got to ask these questions for them. Like, can anybody outside the U.S. invest in it? And do they have properties outside the U.S.?
Right. I think that some, so there are different rules. And so some places you don't have to be accredited. You don't have to be an accredited investor. They have stricter rules. They're trying to protect the little guy for good reason, too. So I do believe that people outside the United States can invest in some funds or in some syndicated offerings, but others, the operator might close it to them, even if the government allows it, and the government might close some of them down, even though it would be allowed. And then as far as, are there some outside the United States? I don't know the answer to that. I would guess yes. But when you're talking about property rights and different things like that, it's just pretty tough to beat the United States. And until you've made it through all the properties in the United States, there wouldn't be a lot of reason to leave.
You keep mentioning the company that you work with. Is that a group that is looking to take on more investors, more people in the syndication? And if you're comfortable, if not a big deal, sharing the name of what that group is.
Sure, I'd share the name. I don't know whether they're looking for new operators or new people to invest or not. I will tell you that they're not starving for people. Like I've said, they rarely have to even go through a 30-minute webinar to get all their money. Right. And so the name of the company is Western Wealth Capital. That's the one that I deal with mostly through Buck Joffrey that I talked about earlier. I have a friend who became interested in this. He's a physician in my area. He's tried to contact Western Wealth directly, and they haven't even returned his inquiries. So I told him, hey, you probably need to talk to Buck, which is kind of how I got into the situation. So I don't think they're starving,
Right.
you know, for money to come on, and so they want to have these promoters or people that are kind of in between them handle, you know, talking to the people, you know,
Right.
getting them onboarded, you know, having a relationship with them, things like that. So
there you go. There you go. I mean, I'm go, Kyle. I think I've kind of drilled down, you know, all the you know questions that I got. I like it. I like this.
Yeah. I
I
mean,
do.
it's that you hear with investing, if it sounds too good to be true, it usually is.
Right.
And that's my biggest concern with
That's it.
getting 30% returns. There's, I'm I want to see what the flip side is. But you know, everything that you described, I mean, it all makes sense. Especially, you know, you hear in, you know, from everybody that the best way to build wealth is real estate, because you know there's never going to be more property or land available. There's a finite amount, and populations are only growing. We have to live somewhere. Um, so I'm very interested in you know looking into the podcast that you mentioned, and learning more about it, because um, yeah, there's definitely better ways to get that financial freedom.
Well, I mean, honestly, Kyle, and I think I agree. Completely agree with you, right? I feel like just like with anything, there are people that are supposedly experts. I call them Instagram experts, you know, and then there are people that are true experts who have done this for a long time.
Right.
And I truly believe track record. If you have a track record, you're going to want to do what? You're going to tell everybody, show people, this is what I've done.
Right.
When somebody doesn't want to show you their track record, that's kind of the first red flag.
Right. Right.
Right. The second thing would be if you just, you know, started doing this last year. You know, if I just started, investing in the stock market last year, I'm not going to sit here and say I'm going to start a class to teach other people how to do it.
Right.
No one has lost yet.
Right.
You know, that's why I'm saying, like, there are certain times along the way where it was tough.
Right.
How did they get through that? These are the questions that I would ask.
Right.
You know what I mean?
Is there?
Those are great questions. The other thing, like I told you, I have thousands of hours in podcast listening. I mean, Stitcher used to tell you like how many hours you had. I don't know if you can still find that number, but let me tell you, it'd blow you away. You'd think like, what have you done with your life? You know, if you knew how many hours that I'd listened to. But it's got to be. If it's not 10,000, it's close. You know, I mean, it's a lot that I've listened to, and so the one thing I do know now that I can. If I watch other, you know, operators and their offerings, I just think like, wow, like that doesn't even sound good, you know, anymore. So once you listen to a lot, you know, nothing's a for sure thing, but you have to really know, like, and trust these people. Those properties that I bought in Texas, I got on a plane in Twin Falls, Idaho on like 8:00 at night. Took the red eye to Memphis, spent the day with that company to, you know, I wanted to meet the people that I'd be dealing with, and then, you know, got back on a flight and flew back the next day, you know. So the same thing with the people that I went down to meet in Arizona. They showed me the places that they had. We drove past others of theirs that we didn't even stop at, you know. You could tell from the black and yellow signs it was their, you know, their places that we'd gone past. So yeah, you really have to, you know, you kind of have to be a believer, and so, you know, we'll have to talk again sometime when all these start to roll through. You know, like I told you, my first one's rolling through right now. I did have another one that was not with that company, that was in self-storage.
Okay.
They bought something in they bought a self-storage unit in Tennessee. They planned to hold it for 5 years. They got an offer that was too good to be true. Well, not too good to be true, because it's supposedly true. We're getting our money back after 13 months, and it's about a 57% return.
Wow.
So, just like you said, the numbers that they gave is, hey, let's say you put in 100,000. They have paid us out already like 3,000 or 4,000 over the course of a year, but they're going to pay out another 53,000 and our money back in a year. So the two that I have that are kind of coming full circle, One is what they consider a dog at 14%, which is still pretty good to me. It's not as good as your crypto, probably, but
nothing is better than
depending on the day.
Dogecoin and Inu, whatever. So
yeah, but one's 14% a year over 3 years. The other one's 57% in 1 year. And again, they expected to hold it longer. Some of the people were a little bit upset that they were actually kicking us out in a year, but they said, "Hey, this is the number we thought we were going to get out in 5 years. So this is it. This is it."
So it sounds like the key is finding that right promoter to give you access to the deals.
That's the key. Yeah.
Wow. Okay. Well, honestly, Justin, thank you.
Yeah.
Thank you so much for taking your time. From listening to other podcasts to come on to this podcast. So we appreciate you for sure. You know what I mean? And thank you very much for educating us on basically other means and other ways to make money, so that dentistry is something that we do for fun, not something that we have to do, right? And in the end, you gave great advice to even newcomers, new dentists that are just great, coming out. I wish I would have thought about that. My first paycheck would have went towards a fourplex. I'd have been sitting there feeling good right now, but instead I have a fake background, This could be a real background, everybody. So we definitely appreciate you coming on, man.
Yes,
thank you so much.
Well, thank you. And I just want to say, a lot of those hours, or not a lot, maybe not 10,000 hours, but a lot of the hours that I've spent listening to podcasts is you guys have been on those podcasts. I will say it's at 1.5 times. So I do listen to you a little faster. You guys have been talking a little slow today, but
I do the same. I do the same.
I appreciate what you guys have done, just for especially for young dentists, but also for guys my age. I just enjoy not being alone. It's good to hear. Good to hear you guys.
And that's it. And that's exactly right. So whenever everything goes through, please come back.
Yes.
I would love for you to break it down and be like, guys, what I said was right, or nope, I missed on this one. Because the one thing we want is honesty. One thing we want is for everybody to know that we're being transparent, good or bad. We don't have sponsorship for a reason. I don't think anybody would want to sponsor us, but that's another thing for another day. We do this because we care, we love it, and we want to make sure that everybody understands why we're basically looking out for other people so we can ask the right questions. So thank you again, man.
Yes,
really appreciate your time.
Sounds good. Thanks, guys.
Real quick, how can anybody get a hold of you? Any social media, any email, whatever it may be. How do they get a hold of you so if they have more questions?
I guess I'd just give them my email address. I'm only a lurker on social media and usually just a lurker on podcasts too. But so my email address is drjcress@gmail.com.
Awesome.
So I just lost my email address of the last almost 20 years. It goes dark on the 2nd, so I'm having a hard time with my new Gmail address. So.
Jeez.
One of those AOL holdovers.
Yeah, I was going to say.
Maybe not AOL, but
no, we know somebody who's AOL.
Yeah, my local cable company. So.
But thank you, man. Really appreciate your time, honestly. We'll get this up there so everybody can learn as much as possible.
Thanks, guys.
Come back on, man.